All right, let me move you guys up. All right, so today is the third, I'll say, episode in the Investor Savvy Agent series. So thank you guys for joining. My name is Anna Bialek. I don't think I've ever done my intro, so who have watched this and don't know me are like, I don't know who this chick is. But I'm Anna Bialek. I'm a Northern Virginia realtor. I am a reformed government employee. I worked for the Navy for 20 years and then decided I didn't want to do that anymore and became a real estate agent, which I love, but I realized I was still working for money. And I read a book that changed my life called The Cash Flow Breakfast Club, which introduced me to real estate investing. And I realized I can do real estate and I can build wealth and I don't have to work until I'm 80 opening doors. No offense to those that do, but that's not what I want for my life. I want to do real estate on my terms, not because I need a paycheck every month or every couple weeks. Anyways, that's me. So I've been doing this. I've been an agent about 3.5 years, and I've been investing about 2.5 years. Um, I have my husband and I do it together, and together we have 11 rental units in a bunch of different places. We have six in Ohio, one in North Carolina, and four down in Southern Virginia. So, we kind of put our money where our mouth is, and we're kind of applying all the things that we've learned. All right, today's topic, creative financing 101, helping your clients and yourself invest without 20% down. So a lot of times people are intimidated by real estate investing because they don't feel like they have the funds. They don't know how to get into a deal because they think I need a lot of cash. I need 20% down. And that's not always the case. So here in today's class, we're going to talk about some ways to do that without the 20% down. And this is, again, like I said before, these are just scratching the surface. There's so many ways to do investing and to creatively finance and ways to mix things up. But hopefully this gives you like an insight and gives you ideas on how to get started. Ooh, I don't know if you guys heard the ding. Okay. So, like I said, today this is what we're going to talk about. I probably should have gone to the slide when I was talking. So, we're going to talk about 5 strategies. Like again, and there's many, many more, but these are 5 basic strategies that you can use or you can teach your clients to use. I'm going to talk about some real world examples from investors that I know or that I have applied myself. And then towards the end, we'll talk about a couple just talking points that kind of start these conversations with your clients if you want to apply it to your clients. Computer's so slow. Okay, so we're just gonna jump right in. I feel like I'm missing the slide, but that's fine. So strategy number one, I've talked about this before. It's house hacking and live-in options. This is where someone can get a first-time homeowner loan, an FHA loan. They can use their VA benefits. They can use the USDA. So I put that here because those are options where you can put 3.5% down with an FHA, 0% down with the other two loan options if they qualify. And this is what a lot of people don't think about or don't realize. In most cases, you can buy a multi-unit building up to 4 units with these type of loan products. People don't think like, oh wait, that's a commercial property. But if you decide to live in one of the units, you can actually purchase a building that has up to 4 units and rent out the other 3. Some people, it's hard to get multi-units. I will say that in certain parts of the area, they're very coveted. So the other way that people do the house hacking option is by either buying a property. I have a friend, I think Nico might be on here. He bought a property and he turned his lower level into what's called a midterm rental. So he has it furnished and he has a tenant living down there and they're helping him pay his mortgage. And he used, I don't know if it was an FHA loan. I'll ask Nico to share later if he's on, but that is an example right there of how you as an investor can get into a property for little to no money down and have someone else start that journey into investing and have somebody else pay your mortgage. So like it says, pros, low or no money down, easy entry to investing. A lot of investors start here because it is a lower entry barrier or lower barrier to entry. The cons, of course, is that these are conventional type loan products. So there are loan limits, that's income ratio. It's based on you qualifying, not the property itself. So you do have to, have good credit, have income coming in that you can show for these properties. In some cases, depending on the lender, if you have an investor savvy investor savvy lender, sometimes they can work things out where if you can show that you're going to have income coming in from a tenant they might be able to work that into your income when they're doing the loan products, but that's really lender specific. All right, man, I feel like I need to slow down. I'm almost 10 minutes in. Strategy number two, I've talked about this one before. This is DSCR loans. This is debt service coverage ratio loans. And this I've talked about before in other trainings, which if you haven't seen, they're on YouTube under FYR, the FYR University. I'll find the link and I'll send that to you guys if you guys don't have it. Where you basically let the property qualify for itself. These are loans, they are considered commercial. So right now, I'm going to tell you these are at least 20 to 25% down. But when we get later into the presentation, I will show you how you can turn these into not 20 or 25% down by combining it with some other tactics that we're going to talk about today. So with DSCR loans, essentially, the loan is based on the income that the rental property can produce. The mortgage lender is going to look at the rental income that can come in on the DSCR loan, and then they're going to compare that to the mortgage and any HOA or condo association fees. They're going to add that together, subtract it from the monthly payment that you're bringing in. And as long as you can cover basically those expenses with the rent, you can usually qualify for a DSCR loan based on the property itself. So you don't need your personal income, scales with your portfolio. So there isn't the same loan limits that there are with conventional loans. But like it says here, con is it usually requires 20 to 25% down, unless you get creative, which there are ways, and we'll talk about those later. And they usually do have a slightly higher interest rate because they are considered commercial type loan products. And normally they're only given to corporations or LLCs. So you would need to put it in an LLC. It wouldn't be in your personal name. I like to sing to myself when I'm nervous. So let's see. Does anyone have any questions so far? I'll take a break there in case anyone has questions so I can catch my breath and
And
not.
yeah,
Yeah, go ahead.
for the first strategy, let's say
Mm-hmm,
you buy a house and
mm-hmm.
then you're ready to go to your next one. How do
Yep.
you make that jump considering they see that house as your primary? You know, you go to rent out that whole house or
Mm-hmm.
wherever you're currently living, you know, do you rent for another year temporarily and then buy your second one as a primary again?
So for the FHA, that's probably where that's more of a sticking point where you jump from one property to the next because you have to be usually, and if there's any loan officers, feel free to jump in and correct me. Usually you have to be renting or not have owned a home within the last 3 years to be considered a first-time homeowner. With the VA loan, I know that one a lot better than I acknowledge than the USDA loan because I have military ties. You can have more than one VA loan depending
Mhm.
on the limits for like how much eligibility you have available to you and where you're buying properties. So with VA loans, you can choose to, if you have the eligibility available, you can basically go from that place, rent it all out, and then move on to your next. I have had some people, I guess, depending on what your rate is, and you'd have to do the cash flow analysis. They basically take that first property and roll it into either a DSCR or some kind of conventional loan product so that they can, for the VA side, basically free up their eligibility again and then move on to another property. So,
Okay, so you could refinance your primary
mhm.
to then jump to your second one. You change that loan. But going back to what you said, if you're standard, you're not VA, then you would basically have to go back to renting for a period of time for 3 years to then buy your next one.
Correct. Although at this point, hopefully you have enough cash flow coming in from that first one where you can have a little bit of a down payment saved. And a lot of times, if you have the right lender, I will say you can still get a conventional loan with a pretty decent down payment and rate. I think you just have to be creative. And I will also say, we'll get to this later. There are ways to mix and match these strategies. So, and I'll give you a sneak peek. Like maybe you're going to go ahead and you're going to get your next one and you don't want to put 20% down, but maybe you have a rich uncle somewhere. So you're not putting 20% of your own money down. There are instances that we'll talk about in a second where we put other people's money down.
Use other people's monies. That's a Kiyosaki.
Yes, other people's money is the way to go. Leverage, leverage, leverage. Did that help answer the question? Okay, cool.
Can I
Um,
ask a question real quick?
yeah, of course.
Thank you. I wasn't sure if I heard you correctly. The DSCR loans,
Mhm.
did you say you have to have an LLC for that? I can't remember.
Yeah, usually those are considered commercial loans, and so lenders give those to commercial entities. So you would just need to go get an LLC, which I've done multiple times, and it's easy enough to go online, get your, tax ID number, register it with the state, and then once you have that, it would be the loan would be to the LLC.
I don't know how I did it. I do have a DSCR and it's in my name and not in an LLC. So I was wondering, how hard and fast that rule actually is.
It depends on the lender. In most cases, it's the lender and I'll say the types of loan products they're dealing with. I will say that's probably, yours is probably, as far as the lenders that I've worked with, it's more the exception than the rule. Like to have it in your own name, most lenders want it in an LLC or a commercial
Interesting.
entity's name.
Wow,
Um,
they didn't even mention that to me.
Yes, which I mean, personally, I prefer it that way. We have several LLCs. Part of it is a liability thing because we can separate our properties as long as you're doing your accounting correctly. If you have things in separate LLCs, it helps you if something happens and goes sideways on one property and you get sued. There is some protection if you have your other properties not in your name and in other LLCs. You just, like I said, accounting has to be on point because they call it piercing the veil. Like if you commingle funds and things like that, that liability protection goes out the window. But there is a reason why they prefer it in LLCs, and some of it has to do with that liability protection.
Okay, thanks.
No problem. All right. So, ooh, this is one of my favorites. This is also probably one of the hardest, and I'll say probably one of the more advanced ones here. Strategy number three is seller financing. And most people are like, I don't know what that means. So basically, this is where if you have a seller and they own the property outright or have a very low balance on their mortgage, usually these are older individuals. They've been in their property for a long time. And what they don't realize is that instead of a bank collecting the benefits of providing a loan to a buyer, the seller can actually become bank, where they are basically extending a loan to the buyer. They become the bank. This does require paperwork. It's not just a handshake deal. You would negotiate terms. And I really like seller financing because it's so flexible. You don't have to, like it says, it's easier to qualify. You don't have to go through a credit check in most cases. Um, and everything in the agreement is negotiable. It's kind of figuring out, and this is where actually we were talking earlier with Kyle and Christine about having that conversation with the owner of the property to see what it is that they need and want and kind of finding their pain points and figuring out a way to resolve their pain points. So some people really like the idea of having a monthly annuity. So you know what? If you have a seller, actually I'm going through this right now. I have somebody that was referred to me. She's owned the property since 1988. So it's fully paid off. It's in a great neighborhood here in Northern Virginia, but she doesn't want to get hit with capital gains. That's another issue because she's owned it for so long and the property values have gone up so much. She thinks she wants to keep it, but she's not sure she wants to be a landlord. And she likes the idea of having monthly payments come in like a landlord does, but she's not sure she wants to deal with tenants. So seller financing is actually something that I proposed to her as an option where we negotiate rates, we negotiate the term. I mean, everything is negotiable. You can negotiate 0% interest rate, maybe offer them a little bit more money. You can negotiate a 30-year amortized schedule, but maybe you pay it off in 10 years where you have like 9 years of lower payments and then you do a balloon payment at the end, but it's amortized over 30 years. So your monthly payments are more manageable. Seller financing can be really fun if you know how to approach it. Um, the downside is not all sellers are open to it, and I think, in my personal opinion, that's because most of them don't understand that they can become the bank. And in many times, when newer investors or agents that don't understand it are trying to explain it to them, they're not addressing their fears. So a lot of people are concerned with the seller finance because they're like, well, what if the person doesn't pay? Well, with seller finance, you would draft a contract, you do a lien on the property. The seller would essentially put a lien on the property just like a bank does. There would be a note against the property. So when you look it up, that person's name would be essentially the bank holder, the lien holder. And you could, if the buyer were to default, then the seller has every right to then go after and evict the person and recoup, foreclose on the property essentially and get it back. So that's one of the things that people sometimes worry about is like, well, what happens if the person doesn't pay? And so I tell them, well, we'll record a lien on the property with the city or the state. And that way you have yourself, you're covered. Some people are older, so they're worried about like, well, if this is a 30-year term, I don't know that I'm going to be around that long. What happens then? And in most cases, you can write the agreement where it says that the payments, the loan basically transfers to the person's like next of kin or within their trust. It basically gets passed on to the next person in line. But again, those are all the kinds of things you have to talk to them and understand what their fears are so that you can address them and come up with a solution. And then at the end, one of the cons, which I mentioned, is sometimes it may require a larger down payment. This is not always true. It kind of depends again on what the seller needs. Like if they need a larger down payment to buy their next property, you just have to run through your numbers and see if it makes sense. And then the balloon payment is where I was talking about, like, excuse me, you may work it out with them where they amortize the loan over 30 years, but maybe they want the full payment in 10. Another pro that's on here that I touched on a little while ago that I forgot to put on the slide again was the capital gains. I'm not an accountant, so I'm putting that up front now. But if the person has a lot of equity in the property and they're afraid that they're going to break the thresholds for the capital gains taxes that are in place right now, um, with doing seller financing, it defers some of that tax burden because they get taxed on the income that they receive in the year versus the entire lump sum that they would get if they sold the property right now and they were to get a check cut for $300,000 or $400,000 in one fell swoop. They would have to pay the full taxes on that amount in the year that they received it. With seller financing, that gets broken up over the course of the loan because they only have to pay the taxes on the amounts they received. Does anyone have questions about seller financing? This is one that you could pretty much do 1,000 different ways. Okay. Let's see. Oh no. My computer's super slow right now. Okay. Partnership. This is another strategy which can be fun, but it does take relationship building and questions. So this is one, and this is where I mentioned maybe a rich uncle, is where you split the work. And in a lot of cases, and this is kind of from the investor perspective, or you can share, of course, you can share any of these tactics with your clients. But essentially, as real estate agents, we have a front row seat to tons of deals. Like usually first wants to know about things that are coming on the market, but maybe we don't have the funds to put the deal under contract to get the renovations done. And this is where you end up working with another person. And it can be in different capacities. A lot of times you have someone that has a large amount of money. Maybe they want to invest. Maybe they work full time at a W-2 and they have some investments in stocks, but maybe they want to diversify a little bit. This is where you can come to them and kind of lay out and this requires a little effort on your part as the investor with bringing the project forward, because you have to be able to present it to someone just like you would any investment and explain to them what the pros, what the cons are, what the solutions are, what the gain, what they stand to earn from the investment. My brain stopped working for a second there. You can bring the property and they essentially bring the money. There is lots of people out there, especially in my area, in the Northern Virginia area. People have really well-paying jobs and most of them like their jobs, but they have money that's just kind of sitting there and they want to diversify and they want to invest it. So if you can find a really good deal and you put the legwork in finding the deal, maybe managing the project, then you can partner with someone and have them bring the capital and the cash. And so this is one of those instances where I mentioned earlier, where you're not necessarily, maybe you do have to put 20% down for some sort of loan product, but you're using someone else's money to fund the project versus bringing money out of your own pocket. Some of these partnerships aren't just money either. Sometimes maybe you're the person that has the money, but you don't have the experience in real estate investing. So there's lots of folks out there that are more than happy to share their real estate experience and basically teach you as they go as far as managing the project. And they may not bring the money, but they bring the experience. to the partnership. So it really depends on what your strengths are. Usually for an investment to work, you need time, you need money, and you need experience. So depending on where your skill sets fall, you want to partner with others that kind of fill in those other spots where you have your weaknesses. And then you can come up with strategies. And all of this should be written down. It should all be like black and white. You should put a contract together, see a lawyer, have it all drafted so it's very clear on who gets what. And in a lot of cases, you determine equity splits, and you'll say, okay, if we sell this property, let's say it's a fix and flip. If you sell the property, so and so gets this much equity because this is how much they put in as far as funds go. This person gets X number because they maybe have a project management fee that they both agreed to. And then maybe they split the proceeds 50-50. But you also have to remember sometimes there are losses. So when you have these agreements, you also have to look at it from what if that was going to curse? What if things go south? Is how are you going to also split those losses, or if extra money or capital is needed? All of these things need to be worked out. I think partnerships are a lot like seller financing. It's about finding out what the other person really needs and coming up with a solution that works for everyone. Something that I've done with my husband when it comes to partnerships is created a pitch deck, which I got the idea from one of our investor communities, which basically it's like a resume. It's about my husband and I, and we talk about all of our investments. We talk about who we work with, our mentors, and I'll say investor folks that are light years ahead of us and more experienced. And then we provide a snapshot of our financials. And then part of that package, if it's for a specific deal, kind of outlines what the deal is, what we think the repair value is, what the equity shares could be, what the investor may stand to gain if they were to invest in the project. And these partnerships can be any length of time. Sometimes they're short partnerships where you're doing fix and flips. And if you can find someone that has money and you can create successful partnerships, a lot of times these investors will basically let you keep rolling their money over and over and over. And we have a couple of friends that are like that, they basically have like 2 or 3 private or partnerships or private money lenders that basically help them through most of their projects. Sorry, I'm kind of going on a tangent and I'm going to take a drink. I was way more chill when I was sitting in a hotel lobby with like toilets going and coffee makers going. All right, we're getting to the end. Almost there. Strategy number 5, I've actually employed this strategy myself with my husband. This is actually how we got up to the 11 units that we have now. In most cases, we did use some other tactics, but this is the one that we used, is HELOCs or equity leverage. So this is for folks like myself, that maybe you're in your, 40 something, mid 50s, whatever. And you have a property already. Like maybe you started out, you bought a house, but now is when you're starting to think like an investor. And what we did, hold on, there we go. What we did was we didn't want to refinance the property that we live in, our primary residence, but we've owned it for 20 years. So we had a ton of equity in the property. We didn't want to refinance because we have a fantastic rate on the little bit of low debt that we have against the property. So we're like, how do we get access to the equity in a home that we currently live in without refinancing? Because I know we all talk about how much equity we have in our property, but equity is literally just a number unless you do something with it. So we ended up getting a HELOC, which is a home equity line of credit. I would recommend going to a couple different lenders and just kind of seeing what their HELOC products are and what their terms and rates are. We went to 2 different ones. We actually personally went to Citizens and Navy Federal because we had banking relationships with them. And we asked about the terms and rates. And we ended up getting a home equity line of credit against our property. And it's like a revolving line of credit. It's like having a credit card against your house. In our specific case, it's market rent, market rate. A lot of HELOCs are not fixed. They're based on whatever the market rate is at the time, but many of them are also interest only. So that helps kind of mitigate the monthly payments when you're buying properties. So what we did personally, oh yes, Christine, I see your hand is raised.
I was going to wait till you at least finished your thought, but I didn't want to forget my question either. So thank
Oh
you.
no, go ahead. I saw the little bubble pop up, so my thought had already stopped.
This is okay, sorry. This is so this is where my brain stops actually. In
Okay.
a lot of these, I get so excited and then my brain's like, nope, can't do that because this, and this. And it comes up with all these reasons that I can't. Hello, 5-1 generator, overthinker. Um, so my question is with these HELOCs, and I think you
Mhm.
were starting to touch on it. You have to go to different, you don't have to, but the best idea is to go to different places. It looks like Kim said credit unions are a great place too that have good rates. And then they
Mhm.
have interest only because this is where my brain shuts down. It's like, okay, we have all this money in the house and we can use it. One thing you have to be careful telling them what you're using it for, right? Or that's something different. I don't know. And then the other thing is how like if there's a payment, I'm just the money part gets so confusing for me for some reason. It's like, okay, I'm asking for this line of credit. I get the line of credit. So it's like a
Mhm.
credit card. That was like perfect. And that means you only pay for it if you use
You
it,
use it.
but
Correct.
you always have access to it.
Correct.
Okay, so I get that part. But then if you do use it, a
Mhm.
credit card requires minimum payments or something. So what does that look like? And how long do you have to pay it back? Like all those things.
Okay. Yes. So I will say how long you have to pay it back depends on the bank. This is kind of where I was saying talk to the different lenders. So I can speak specifically to the HELOC that we got as an example because I know it very well. So we ended up getting a HELOC for the property. It's essentially it's a 10-year draw period for us. So we have 10 years to basically draw from it, pay it back, draw from it, pay it back, draw from it, pay it back. And then at the end of the 10 years, if there's any balance left, then essentially it converts into a fixed rate loan product for an additional 10 years at whatever the market rate is at that time. And then we would have to pay it back. So that's kind of the structure of the HELOC. And you are correct. You don't have to pay interest on it if you're not using it. So if you just opened up the line of credit and had it sitting there, there are some fees like any loan to get it initiated, but they're minimal in the grand scheme of things. And then if you're not using it, you're not paying on it. Then once you use it, I will say it depends on what you're using it for. So we used ours to buy rental properties. And so sometimes there may be a little bit of a gap, like if you don't have tenants in it right away, like if you need to do some renovations, there may be a little bit of a gap where you're making the monthly payments. When it's interest only, depending on how much you're drawing, I'll say it's not terrible. It's not like a full blown, you're not paying $3 or $4 or $5,000 like you would on a mortgage, depending on where you're buying it. Like here in Northern Virginia, that's pretty standard mortgage. But what we have now is the properties are rented. So that rent is more than covering the monthly payment for the HELOC. And then our goal, though, with the HELOC is to continue to leverage the equity in the house. So what we've done in two occasions with two of our properties is we use the HELOC to buy them cash. You don't have to tell the bank what you're using the money for. You just basically put your house as collateral and you pull the money like whenever you need it. We go to the bank, we do a bank transfer into our checking account, and then basically we pay for the property cash. Like the seller of the property has no idea how we got these funds. They don't care. They just want the money. And so we've used that, we've bought the property, we stabilized the property. And then what we've ended up doing is once we have a renter in the property and stabilized it, is that we've gotten DSCR loans, which is the other strategy that we talked about earlier. And basically, if you run your numbers right, in most cases, you can pull most, if not all of your money when you refinance into a DSCR loan out of the property. Sometimes, you may have to leave a little bit of money into it, but most of the time you can refinance it and then use that money to pay off the HELOC, which then frees up that line of credit again. So you basically put leverage against the rental property itself that you bought with the HELOC, and then you put it back into the HELOC and pay that off. And then that frees up that line of credit again that you can use to buy another property. And basically, you just keep rolling the same line of credit over and over again. You just have to run your numbers, be judicious in running your numbers and your rental numbers to make sure that that works out. Or when you're buying a deal, most people say you make money when you buy a deal. If you buy a good deal, you want to do the analysis to see, like, if I buy it and after repair value, how much do I think I can refinance it for? Um, that's probably another class of like figuring out how to do that math. Um, but that's how we've used it. And we've been pretty successful with it as far as basically buying it, using the money to buy things cash. Because sometimes we can get a better deal if we can go to an investor and pay like cash for a property versus trying to get financing because we can just close faster.
I have a question.
Yeah.
When you use your HELOC, when you go after a HELOC,
Mhm.
Say there's a property, you've got a loan on it. I'll use my one that has the DSCR loan. We put a
Mhm.
healthy down payment. There's a renter in there. So the equity is pretty good right now.
Mhm.
You want to go use a HELOC on that property.
Mhm.
When you go to apply for a HELOC, I've never done a HELOC before, so I don't know what the bank wants from you. Do they want W-2? Do they want your income? Stuff like that when you go normally to get a normal loan.
Yeah, they usually do it. It is similar to a normal loan. They will ask you for like W-2s, and other like credit scores, your own credit scores. So you do have to have some of that going for you, like you would with a conventional loan. The other thing that they would look at is, so like with my property, for instance, they looked at the value of the house. They did send an appraiser out to take a look at our property. They came up with whatever the appraised value was. They subtracted out how much our loan is on the property, and then that left a delta, and then they were willing to loan up to a certain percentage. Like a lot of banks have like caps on how much the HELOCs are. Like we may have, you know, $800,000 in equity, but like the bank that we ended up going with, the Citizens, they had a cap, so our HELOC was $500,000 because that was the max. But that's because, you know, we had good credit, our value of the property was X, the loan amount was very low on what like Y. So they were like, okay, this is how much equity is left in the house. And they felt comfortable giving us the 500,000 line of credit. Because if, God forbid, knock on wood, something happened and we got hit by a bus and they had to take our house, they feel fairly confident that they're going to recoup their funds and then some.
Okay,
But when
thank
you
you.
but when you do that, don't they ask you what do you want it for? And if
No,
they don't,
mm-mm. No, they didn't ask us what we wanted it for. They basically, we just told them we wanted a line of credit for against our property.
but they didn't ask what they wanted it for?
No,
Okay, and when you take it out, they don't ask you what you're using it for. Like
no,
when
you
you
literally go to the bank and you say, I need to make a transfer from my HELOC into my checking account. And you go and you do the transfer from your HELOC into, it's like moving money from a savings account into a checking account.
okay.
And no, they don't ask you what it's for.
Okay, cool. Thanks.
And no, no problem. Yeah. So they move it literally into our checking account like it's cash. And then we basically do a wire transfer from our checking account to the
Right.
title company to pay for the property. So
Hmm.
no, they don't ask. I mean, with the bank we use, we've been there enough times that they know us. So they're usually like, oh, what property are you buying now? Because we've had that discussion, but it's not a requirement for the loan.
Okay, and so then at that point, if you, let's say, because you said you mentioned numbers, so I want to,
Yeah.
numbers sometimes make it easier for my brain to wrap
Yep.
around. So if you've got a $500,000 line of credit and
Mm-hmm.
you purchase a $450,000 home and you're paying cash for it, then
Mm-hmm.
what does that look like as far as monthly payment wise for the HELOC? Are you paying the interest? I guess it
Yeah.
depends on the program, right? Or is it
Yeah.
interest and then the
Ours
interest?
is Yeah, ours is interest. Our HELOC is interest only payments. So we're not paying principal and interest on that. We are paying interest only. And then, of course, like taxes and insurance, we have to pay on our own dime because there isn't a mortgage against the property itself,
Okay.
where they're collecting that in an escrow account. So it is our responsibility to make sure taxes and insurance are paid for. And then we pay interest only payments on the HELOC until we're ready to refinance the property. And then it goes into a more traditional loan product that has the principal, interest, taxes, and insurance all rolled into it.
And you do that like later on once you have a renter, a tenant, whatever, so that you can show the numbers or that you have income coming in and it just makes it easy,
Correct.
I'm assuming.
Yeah, yeah, especially if you're doing a DSCR loan. Not all, some lenders, and so this is where with DSCR loans, the rates may vary, but like if you have like a lease in hand with a rental amount on it signed and you can show the lender for the DSCR loan product, like this is I have a signed lease, this is how much I'm renting it per month. It just like, okay, they know that you have someone in place. It's not like um, I think I can make this much in rent and hopefully I'll get that in like 6 months or whatever. But yeah, normally we have preferred to wait till we have a renter in the property, have a signed lease, and then we can provide that documentation.
Cool. And then at that time, you're just using that rent to pay the HELOC and then a portion of it you're putting away so that if you need to take care of the property, whatever. I mean, I know that's
Yep.
probably the next question, but
Yeah, exactly. We're using the rent to basically pay the HELOC and put money aside for capital expenditures or like maintenance or any of those kinds of things. And then I will say when you do go to refinance it into a DSCR loan, again, it's a lot, all of it's math. At the end of the day, you have to crunch your numbers to make sure that whatever rate you're getting into when you do the DSCR pay, like loan product or whatever loan product you're getting into, that your rent still covers your mortgage and your expenses. So like there's one property that we've left on the HELOC for the time being because it just made sense to keep paying interest only for now while we continue to stabilize the property. We could put it into a DSCR loan right now, but we are like, no, it's a little uncertain. So we feel better about just paying the interest only payments on that one. That's a personal preference, but that's like the risk reward factor that you have to think about.
Cool. Awesome. Thank you so much.
Yeah, no problem. So we talked about most of this. So flexibility, access to funds, no need to sell anything. You don't have to refinance if you have like the 2.5% on your current interest rate or on your current home. I will say, and I haven't done these yet, and these are much harder to come across, but there are lenders that do HELOCs on rental properties. So I have a couple leads on those lenders. So I need to get with them because we have like a property in North Carolina that we bought at one point before the market skyrocketed. So we have quite a bit of equity in that property. Finding lenders that do HELOCs on second homes or rental property portfolios is a little bit harder, but it's not impossible. So it is another way to leverage some of your other properties by tapping into that equity. But I can't say it enough. You have to run your numbers. It's good to use leverage, but you have to use leverage smartly and don't overextend yourself because then you end up in a position where you end up funneling money into your own investments just to keep them going. So you have to always run your numbers because again, it adds a new debt. And like I said, interest rates fluctuate because in a lot of cases they do market rent or not market rent, market rates. So like our HELOC fluctuates. If rates go up, our rate goes up for the month. If rates go down, our rate goes down for the month. It's really nice on those months when rates go down, but they don't seem to do that very often. Okay, now I have to go back over here. My computer is so slow. I tried to run this from Gamma Online and I should have just downloaded it. Okay. Is this the one? Yeah, okay. So this is planting the seeds with your clients. So this is where I'm going to pivot a little bit. So a lot of this is for you as an agent to become an investor, but I've used this with a lot of my clients, like especially if when they're going to buy, I usually ask them, have they ever thought about renting it out in the future? Like, what are their future plans for the property? Some people don't even consider what that looks like. So sometimes when I talk to a buyer, if they show any interest in maybe keeping it as a rental one day, a lot of times I will also provide them with what the rental rates are in that current area where they're shopping, just so they have an idea of what they could potentially capture in rent. This could be a great live now or rent later option. Those two kind of tie together. The other thing I do with a lot of my buyers is we're walking through a property, I start planting the seed of like, hey, this would be a great walkout basement. Like this might be a good rental unit at some point. I love a house with a good walkout basement that you could turn into like a small studio apartment, or if it has plumbing down there for a bathroom. I point out things like that as we're touring properties. And it's really fun to watch buyers' faces, like the wheels start going. And sometimes people are like, no, I'm not interested. But many times, like you see the little light bulb go off and they're like, huh, I didn't think about that. Because especially with first time home buyers, I'm very pragmatic and I'm like, this is not your for her. In 99% of the time, this is not your forever home. This is a stepping stone to build wealth so that you can eventually get to that forever home. And let's make sure we're looking at that longer term picture. I will also say with sellers, like I said, I have a seller now that I'm working with, and she's not sure what her options are. And we started talking about seller finance, where one of the questions that's not on here that I ask them a lot of times is, how would you feel about becoming the bank? You know, what's important to you? Do you need the lump sum, or does the idea of having an annuity payment, a monthly payment coming in, monthly income coming in appeal to you? So there's questions like that that you can pose to sellers to start to get them thinking. Some of them will consider it and be like, no, I just want the money. But again, it's just like with buyers, it's really fun to watch that like light bulb go off, and it makes you stand out. Even if the buyer or the seller decide to be an investor, it makes you stand out from other agents. You provide them other options and other tools that others may not have given them before. So at least for me, I feel like it's come a full circle where those are the same people that will then refer me to people and say, hey, like she was great. She helped us. She was fantastic in the transaction. And she was also able to give us like options that we never even thought of. Like we never thought about renting this property in the future. We never thought about seller financing, but maybe they know somebody that that would be good for. Um, and then the what if you use your equity instead of cash? That would be back to like the HELOC, which again, some people think they have to sell their primary residence. I know as a real estate agent, some agents probably think I'm crazy because you're like, I want the listing, because who doesn't want the listing? But sometimes the right answer for our clients is not to kind of drive them to sell the house. Sometimes it is for them to keep it as a rental, and maybe you help them rent it out. And I bet you that person will be a forever referral that will refer you to their friends because you help them build wealth with their real estate instead of just looking for that transaction. Like Christine said before, it's very short-sighted to just, I'm going to get off my soapbox in a second, to just look for the next transaction. I know we all need the money coming in, but sometimes the longer term play is turning these clients into investors because they will come back over and over. Once you turn someone into an investor, the odds of them buying a home goes up substantially. Like it's not every 10 years, it's more like every 3 to 5 or less, depending on how excited they are about investing. You don't have to teach. Oh, and this is just like I said, you don't have to teach them. You don't have to teach your clients investing like inside and out. If they're curious, you can pique their interest. You can point them towards resources. It's just, these are just tools. These are tools that we're using to build our own wealth and using these tools to help our clients build their wealth. You just have to learn how to ask the right questions and provide solutions. Because I will say becoming an investor has provided me with so many tools that I wouldn't have had otherwise to come up with creative solutions for clients that I don't think I would have had otherwise. Oh, haha. We're getting close to the end. Oh my gosh, I'm almost taking up a whole hour. That's crazy. Combining strategies. So this is what I was alluding to earlier, is that like these strategies can all be mixed and matched in different ways. And a really good investor, the more experience they get, they figure out how to like mix and match these different types of financing strategies to try to have as little money out of their pocket as possible. So like I was talking about earlier, you can do the house hack with the VA loan. If you get a VA loan, that's 0% down on your part, and then you rent out part of the property and someone else is paying your mortgage essentially. So if you get that 4-unit building, rent out the other 3. If you have that single family with a walkout basement, rent out the basement. We have actually quite a few friends that rent by the room. Like in some cases, especially in high priced areas like Northern Virginia, it's hard to get properties to cash flow. So I actually have friends that live in a property and they literally rent out every other bathroom or every other bedroom in their property. I will say you have to look at your county rules and regulations because there are some restrictions on how many unrelated people can live in the same house. But yes, that is the thing. House hacking goes beyond just renting an apartment or a basement. Some people actually rent every room in their property. I saw Christine's mouth just drop open.
Well, I'm just thinking like I love the idea of the income, but I can't imagine sharing my space personally, like with a stranger.
Mhm.
And obviously it's basically like you have a roommate, really, because now you're sharing
Yeah.
laundry, your kitchen, and you have to trust the person to be in your home if you're not there, if you have pets, like I mean, it's crazy. I mean, I get it, but I don't know if I get it.
Yeah, no, I mean, and a lot of times, like the folks that we know that I know that rent by the room, I mean, they still vet them just like they would any other tenant. Like they still do the background checks, they do the credit checks, they accept the deposits, they learn to put house rules in place, they label shelves, they like put schedules up for laundry and for bathroom time. So, I mean, it's great for people like, and I'm using DC as the example because that's what I know and love. Like people come here all the time for short-term assignments. They're maybe only here for 3 months, 6 months for training or for some, for an office program thing that they're doing for a short period of time. They don't need a whole apartment. They want to save money and they're happy to just have a bedroom. They just need a bed to go sleep in. And this is just a way for people to do that. I heard stories from some of those same friends that maybe they didn't get the right tenants, that every time that's why they like to do midterm rentals in for the rent by the room situation. This particular couple that I know, because if it doesn't work out, usually the lease is only for like 3 to 6 months. So the person eventually leaves, and then they can kind of fine tune their strategy, and they fine tuned it so well that now they're like really good friends with all their roommates, and they're running like the Marine Corps marathon together. So it is possible. I will also say it's a mindset shift. Like renting by the room is more of a I'm going to suffer now so that I have ability and flexibility in the future. Like that's really what it is. It's a stepping stone to get into real estate investing. Your hope is that at some point you can then rent out your room and then move on to the next property. And now that property is paying for itself. So is it a strategy I would employ forever? Me personally, no. But if I was younger and didn't have kids, I probably would have started out that way because it would have been a great way to get started. And I'd be a lot further along now, but such is life. The DSCR loan, private money lending, we talked about that one as well. You get the loan and there is a 20%, 20 to 25% down payment. But if you have a rich uncle, if you have, a friend that's a doctor or dentist, a lawyer, and they want to look into an investment, you can work out terms with them. You can essentially get a second loan. They become second position and you borrow the money from them to put the 20 to 25% down and you pick up a property with no money out of your pocket. Same thing with seller finance and partnerships, same kind of deal. You get the seller finance, you agree on a down payment with the seller, you work with a partner, you tell them, what the benefits are of partnering with you on that deal, and they provide the cash for the down payment. Again, you're in the property, no money down, BRRRRs and HELOCs, same deal. You get a HELOC, you buy a property, you buy it, you renovate it, you rent it, you refinance it, and you basically pay back the HELOC and you repeat the process over again. And that's how you go from property to property. With the BRRRR, that's essentially where you're buying a property and you're adding value to it. So the odds of getting most, if not all of your money out when you refinance increases exponentially because you're making an effort to buy a property that you would increase value, whether it's remodeling it, adding bedrooms, adding bedrooms or bathrooms. It's not either or. You can pretty much mix and match all of these. So it's all about how you combine your tools and use the tools. These are all tools to put in your tool belt. I think I'm almost at the end. Yay! The end. I'll open up the floor to questions in a second. If you want to rewatch this training or the other two that I did before, those are on YouTube. If you want the slides, shoot me an email. That's my email address, and I'm happy to share the slides with you. I'm on Instagram most of the time, so you can follow me there. I do have a podcast. My co-host, Nico, who may or may not be on here. I think I saw him pop on. We actually started a podcast about 2 years ago, which is about agents becoming investors. So we talk about all the stuff that we're going through as investors. And then we have a lot of guests that come on and just talk about different investing strategies, what they've been through. So that's on Spotify, YouTube, whatever. And that's our next training, which I don't know when it is, but I'll make sure to post it when it comes out. It's like in 4 or 5 weeks because we do this on rotation. Yeah. So does anyone have any additional questions? I know we went through a lot of them while we were in the presentation. You can say no.
No, this was so good though. Thank you so much. I really appreciate it. You took like what can be a challenging, at least for my particular brain, information, and broke it down to where it was actually like, I was
Understandable.
Yeah. So thank you.
Oh yeah, no problem. And that's what I'm trying to do. Like when I first started investing, it literally was a fire hose in my face. I was like, wow, this is a lot. And I'm trying to make these as bite-sized and digestible as possible. I know it's still overwhelming, but the more you surround yourself with people that do this, that are just a couple steps ahead of you, the more times you come to trainings like this and read books, it gets easier and easier to understand. The first couple times, it does feel like someone's blasting your face with a fire hose, but it's worth it, I swear.
That's awesome. I have a quick question. Sorry.
Yep.
I know that you say you've been doing a lot, and I'm so impressed. You have 11 doors. That's awesome. So from the time you got your first door,
Mhm.
and then you like, what's your progression been like? I know we talked a while ago about, Southern Virginia and stuff, but I'm
Yeah.
just curious how this has gone.
Um, so our very first property in the portfolio, I'll say, was our North Carolina property, which was an investment, but we weren't really thinking like investors yet. We bought it really as a second home. And we're like, oh, we'll rent it out to friends and family because the equity is great. But I didn't want people in my house. I was like, people are in my house and they're moving my stuff. And so I admit I was not initially treating that like an investment property. I will say, we were accidental investors, and then we joined this community, the Cash Flow Breakfast Club, and started learning about investing. And now we treat it like an investment. So our first one was that one. then when we seriously started doing investing, we started going to investor meetups in February of, I guess it's about 2 years ago, 2.5 years ago.
Wow.
And about 4 months after our first meeting, we bought our first single family home in Ohio. We decided to go out of state because it's really expensive in Northern Virginia, I know you know that. And we wanted to try for cash flow. And I'm going to curse, so I'm giving you the disclaimer to anyone that's listening now. We were like, if we're going to fuck it up, we're going to fuck it up with $100,000 house and not an $800,000 house.
Yeah.
So we bought our first property about 4 months after we started with investing and learning about investing, a single family home. Then about 3 months later, we bought our second single family home in Ohio. And then I want to say it was probably 4 to 6 months later, we ended up buying a 4 unit building in Ohio. That was small, 1 bedroom, 1 bath units. So those are our 6 properties in Ohio. And then last year, it was last May, we picked up a duplex in Danville, Virginia, down in Southern Virginia. We knew we wanted to be in that market because we had ties to the Navy and we knew what the Navy was doing down there, and they put a casino, and there was just a lot of economic growth going on down there. And so we actually sent out mailers, postcards to investors, property owners that didn't live in the property or were out of state. So we picked up a duplex off market down in Danville last May. And then last August, then we picked up another single family home down in Danville, which was also off market. It was from a postcard. They gave us a call. We bought that one, and that one was a single family home, but it was so large as a single family home economically, it didn't make sense to keep it that way if we were going to keep it as a rental. So we got a special use permit to turn it into a duplex.
Oh, nice.
So now that one's a
sorry,
duplex.
you made me think another question follow up.
Uh-huh.
So as an agent, when you're doing these deals, are you like they say, okay, it's $100,000. You're like, okay, great. I mean, is there commission or anything like that involved? Ohio, you're not doing the paperwork, but in Danville, did you do that transaction? Sorry, that's like 5 questions in one.
Yeah, no. So in Ohio, we have an agent in Ohio because I'm not licensed in Ohio, which is fine. We have a really good agent out there that he's also an investor. And so he's been great in helping us pick up properties. So he did have a commission, and similar to us, that got paid by the seller. So for him specifically, we didn't end up having to pay him for any of the properties that we bought, like in that sense. For the ones in Southern Virginia, because they were off market, I did do the paperwork myself. We didn't do any commission or anything. I was just, the price points that we got them for were just like the single family home that we turned into a duplex was gutted to the studs, and we picked it up for $62,000. So we were just happy to get it for that price. So I just did the paperwork and ran it through the title company myself.
Cool, thanks.
No problem.
Anna, do you use property managers in Ohio, or do you do things yourself?
Oh, so I have used property managers. I'll say in Ohio, it's a 50-50. We had one property manager, and this is the learning lesson as newer investors. We got the property manager. We knew we probably should have switched a lot sooner than we did, but we didn't know what we didn't know. And so we did switch to a new property management company, which still isn't great. So it's a hybrid. We have them manage our 4-unit building because I'll be honest, that's our trouble. That's our problem child over there. And then the 2 single family homes have been pretty easy. So I took over management of those from here. And so I use a lot of technology and like property management software to manage like the property in North Carolina, the ones in Southern Virginia, and 2 of the ones in Ohio. I manage them myself.
Will you be open to having a coffee and sitting down and talking about that with me?
Oh yeah, for sure. I will happily teach you all the things that I'm learning as I go, because it's you never stop learning when it comes to real estate investing. But yeah, there's a lot of technology. Yes. All right. I know we're running short on time. I think we have time for maybe 1 or 2 more questions. If not, I can give you back your 60 seconds.
Thank you.
Oh yeah, no problem. Thanks guys for showing up. Thank you for all the questions and the engagement. I love it. This is my passion, real estate investing and building wealth. So that way we can do great things. I will leave you with this. This is something my mentor Anai always asks is, when you become financially free, how are you going to change the world? So think about that, because that's what, for me, what real estate investing is becoming financially free. So we can change our world, whether it's your household, your neighborhood, or the community at large. So thank you guys for coming, and I hope to see you guys next time.
Thank you so much. Have a blessed day.
Thank you. Bye.